Hello and welcome to our next lesson in this set of tutorials on private company modeling and valuation. As you can see, we're finally going to be jumping into Excel in this lesson. And I have up here in front of us right now the sample private company financial statements that we're going to be analyzing and rearranging slightly in this lesson. Now, the motivation for doing this goes back to what we addressed in the second lesson in this module, which is that there are some accounting and financial statement projection differences when you're looking at private companies, especially very small businesses like the one that we're analyzing here. Now, the first point here doesn't really apply because we do have 5 years of historical financial statements, but the rest of these points very much apply here. We're going to have to normalize the statements. We're going to have to reclassify salaries and dividends. And if we are paying out a high dividend to the owner or the management team each year, we're going to need to reclassify that and categorize that on the income statement instead. We may have business and personal expenses that are intermingled, and the tax rates are going to end up being different here because we're assuming that a larger entity with a much higher or at least somewhat higher tax rate has stepped forward and indicated interest in acquiring our business. This point about the key person discount is not going to apply quite as much here because we're going to be assuming that the owners and the management and whoever else is in charge stays in place. We'll actually be adjusting for this later on when we look at some of the calculations for terminal value in a DCF, so this one's not really going to come up for now. Let's go into Excel and take a look at our outline for what we're going to do here. So I'm going to start by giving you an overview of the financial statements for this business. Then we're going to look at how we made some of the projections for the financial statements. Now, the statements themselves have already been completely projected. I don't want to spend time on that because if you've made it this far in the course, you should already know how to do this very well. So we're not going to spend a ton of time on that, but I do want to point out a few of the key differences here and how you see some things that you wouldn't necessarily see for a large public company. Then we'll go into the problems with these financial statements and I'll show you how to make some required adjustments. We'll recreate the statements and create a GAAP or IFRS compliant version of the statements over here. And then we'll do a final check at the end and make sure that the numbers all make sense. So let's start with the financial statements themselves. The overall impression from looking at much of this is that we have a small business that has grown very rapidly from around $200,000 in sales to close to $1 million in sales over the span of 5 years. And going forward, it's projected to grow even more, to go up to over $2 million over the course of the next 5 years. Even for a public company, this would be a very high amount of growth, especially if it's a large established public company. But for a small business like this, this is what would be considered very high growth. Maybe not the same rate as a red hot venture-backed startup that is growing by 1,000% each year or something like that, but still relatively high growth. Now, if you look down, you can see that we are paying out some commissions to promotional partners and other members of our team that deliver services or sell products. But all of this is fairly standard. We have a certain amount allocated to refunds and a certain amount to payment processing fees. All these are pretty standard things that you run into when you are running a small business like this. On the operating expense side, the categories here are all fairly standard. We have tax, bookkeeping, and legal fees, which go up generally over time. Customer support, so we're paying, it looks like 1 or 2 or maybe some combination of part-time staff members to do this. We're paying something for online advertising on Google, Facebook, LinkedIn, and so on. We have web developers because this is a web-based business. We have, it looks like maybe 1 part-time sales rep or something like that. And then we're paying possibly 1 individual or a combination of part-time individuals to do marketing. We have to pay something for the IT infrastructure, so hosting the site, paying for bandwidth, things like that. Travel and moving expenses, this is probably something that the owner of the business is expensing and counting as a business expense, even though it probably shouldn't be. So this is probably one of those personal expenses that's going to have to be removed. Depreciation and amortization. For a company like this is probably mostly amortization of intangible assets that were acquired. And then product creation and content creation. So both of these refer to, it looks like, paying some combination of part-time and full-time staff members to help with the content creation process on the site, writing articles, creating video content, creating written guides, other tasks like that. And then as we go down, we can see we have operating income, income taxes, net income. We have no debt and no interest earned on cash or investments, so we're just skipping pre-tax income altogether. So the overall impressions are we are growing revenue quite quickly. Even in the forward period, we're still growing at around 15 to 20% each year. Now, our operating margins here appear to be very high. They're over 40%. They're as high as 50 or 60% in some of the prior periods. Of course, you probably already see the problem with such high margins, which is that nowhere in these operating expenses do we actually show the salary paid to the owner of the business or any payments to him. And obviously, the business would cease to exist if it is tightly controlled and run by a single owner or even a small group of owners. So the margins are deceptively high right now, but we'll end up adjusting for that later on. Now, on the balance sheet, there's very little to say here because it's such a simple business. We have minimal receivables. It looks like most of our earnings are going straight to the cash balance of the company, and this is being built up over time. And then in future periods, it goes up even higher. We end up with over $2 million of cash by the end of year 10 here, which on the surface seems ridiculously high, but it may not necessarily be wrong. It may just be an indication that this business is generating a lot of extra cash and we don't have a clear sense of what to do with it other than possibly paying it out to the owner himself. PP&E is fairly minimal here as well. This likely consists of items like computers or other equipment or anything smaller like that. Even the amounts that we have here, $19,000 for it, is probably a bit on the high side, but we've kept that for now. And then we have a small amount of payables and accrued expenses, deferred revenues from subscriptions that might be offered. We don't actually do that right now, but hypothetically. And then again, at the bottom, it looks like we are building up a fair amount of equity because we're not even withdrawing close to the amount of excess cash that has been generated over time. The cash flow statement similarly is quite simple here. Working capital is just not a major part of this company's business, which is accurate. For many small businesses out there, it really isn't, especially anything that is software or biotech related or many service-based businesses. It's just not that important. If you had something like a retailer or a restaurant or something else that actually had suppliers and inventory and other items like that, then working capital would be a lot more important. And the same applies to capital expenditures. It just doesn't matter that much here. We're spending maybe a few $1,000s a year on computers and equipment and other things like that. But overall, it's not that significant for an online education / software / training company like this. Really, the main thing to note on the cash flow statement is this gigantic line item for dividends / owner draw. This effectively represents the salary of the owner of the business. So whoever is running the business is simply withdrawing a certain amount of cash from the business each year based on what it has generated in that year, and that is his salary. So we're going to be reclassifying this and putting it somewhere on the income statement because we want to make this a little bit more standard and assume that there is actually a management team behind the company. So that's a quick overview of the financial statements here. And I have some other written notes up here. You can take a look at it if you want. I'm going to go into part 2 now, projecting the statements. Again, we're not going to actually do this in Excel. I'm just going to give some of the high-level overview and a few things that are different about these projections. So to go through this, I'm going to set up a frame. Essentially what we're doing here is assuming that a certain number of new customers each year sign up and they have a certain average customer value. because over time they may be signing up for more combo packages or other combinations or more expensive or higher end courses or services. So that's why the average customer value here is going up each year. Now, this is a bit of a simplification because we're ignoring how existing students and customers might sign up for more courses, but this is just what we're doing for now to simplify it. Now, the rest of the revenue here, if you look at these other categories, we are looking at things like coaching services, sales to institutions like firms and business schools and universities, other products we sell from third parties. All of these are just simple percentage growth rate estimates because they're all much smaller, so we're not even worrying about projecting those too much. On the expense side, for commissions, essentially we pay out a 50% commission to anyone who promotes our products and successfully sells them, and the same goes for payouts to sales representatives who successfully sell our products. Now, I made a mistake here actually and flipped some of the numbers, so I'm just going to go in and fix that right now. So I just reversed a few of those numbers, but that's fixed. And the rest of these are all really percentages of revenue. There isn't too much to say about them because quite simply, as a business grows, you're going to pay more in payment and credit card processing fees. Auditors and accountants are going to charge more, and you're generally going to spend more on all these other items as well. One exception to this trend is the travel and moving expenses as a percent of gross sales. This actually goes down over time, whereas the others stay about the same or move slightly upward. This goes down because even as the business grows, it's not as if you're going to keep spending more and more on a personal expense like this. So we're assuming a slightly different trend there. The other thing I'll point out quickly with the expenses is that some of these categories are more related to the employees that we have as opposed to something that just trends with revenue. Now, we've labeled this full-time equivalents or FTEs. This is a very common practice among small businesses and other private companies, and even some large companies, where they have a mix of contractors and then actual employees, and that's what this reflects. So initially, in the first year, it was really just the owner, me, and then we gradually added more and more people over the 5 years shown here, until by year 5, we had the equivalent of 5 full-time employees. And then as the business keeps growing into the future, we get up to closer to 10 by the end of year 10. So what's important about this is that these are not directly linked to revenue. We're sort of assuming that we just hire people over time, regardless of what revenue actually is. Now, this may or may not be true in real life, but the point is it's just a slightly different way of looking at expenses. And we're looking at it by looking at the hiring in specific areas as opposed to just assuming a simple percent of revenue or something like that. Now, for the salaries, we're assuming that they grow by around 4% each year. And you can see all the math over here. And then on the income statement, when we have an item like web design and development, so we have hired a certain number of full-time and part-time contractors to do that. We're paying them a certain amount, and then we just multiply those two together to get to our annual expense there. So just a different way of looking at expenses. To get these numbers, you need to talk to the owner of the business in detail and see what he is planning to do. Again, the key point is that these aren't necessarily going to trend with revenue exactly, although some of them, like sales reps and marketing, you could argue probably should. The rest may or may not do that because other factors may impact them. There isn't much to say about the balance sheet and cash flow statement drivers because these are all very straightforward and you've seen them many, many times before. So not much to say here. Working capital, capital expenditures, these other items just aren't an important part of this business. So that's an overview of how we've projected the financial statements here. Now, the next part I want to go into is what the problems with these statements are. And we've been through some of this already. And if you go back to that PowerPoint presentation and those slides, we went through the most common issues there. But now I'm going to actually show you what to do in Excel to adjust for these. The first problem is with the income statement presentation. The way it's set up here, if you really sit back and think about it, it's very non-standard because what public company in their right mind would start with gross sales by all these categories and then show commissions and then show fees and refunds and then net sales after fees and refunds. It's just not a standard way to present this. Now, it may be helpful to the business owner, but even when you file and report taxes, you're probably not going to present it exactly like this. So we're going to change this and make it a little more standard. And the same with the other operating expenses. These categories are fine. And if you look at KakaoTalk's financial statements, they actually have something similar where they have categories a little bit like the ones we have here. But generally for companies that you're marketing or you're trying to sell, you try to create more standard categories like G&A, sales and marketing, and research and development. So let's actually go in and do this. We're going to start with gross sales and then net sales at the top, and then bring in all the operating expenses. So for gross sales, let's go over and take our gross sales number from up here, refunds and allowances. Let's just go down and link to our refunds figure right here under fees and refunds. We can then net those against each other to get net sales. For operating expenses, there's some discretion for what goes into each item, but generally we're going to say that payment fees count as part of the G&A expense, as do tax, bookkeeping, and legal fees, as does customer support, as does web design and development, and then also the IT infrastructure. If you look, many of the other items are more related to sales and marketing or developing the actual products. These are more general overhead fees that you need to pay to keep the business running, but which do not actually result in more sales or more products or more new courses for you to look at. So you have that. And then sales and marketing, once again, some discretion is required, but we would classify commissions in this category. And if you look at this, really, commissions paid to people who sell our products and then to sales reps, for a normal company, these would all fall under sales and marketing. The one exception here is commissions paid to coaches, so those who help with our resume editing and coaching and mock interview services. Those are a little more questionable, but we think it's just easiest to put them together with all the other commissions, although you could argue, again, that perhaps they should be part of G&A because they are a form of customer support. So that's a little bit borderline, but that is what we're following here. Now, also within sales and marketing, we want to include online advertising, so paid ads that we're running. We also want to include base salaries paid to sales reps. So typically with sales representatives at a company, they have a very low base salary, and most of their earnings are going to come from commissions. And that's certainly the case here. Even by year 5, it is a relatively low total compensation, but by year 10, it ramps up to a much higher number of more like 120 or 130,000 US dollars. So we have that. And then we also want to include the marketing staff here. So this would include paying for people, employees, contractors to do things like setting up new versions of promotional material or optimizing the site for search engines or setting up advertising campaigns or other things like that. So we have that. And then research and development. For this one, we're just going to take product creation and content creation and include both of these right here. There's a question with this one of whether we should really be capitalizing these expenses. And I'll tell you, in real life, I've actually followed a bit of a mixed treatment here before. Sometimes I've capitalized all or part of these, and sometimes I've just expensed them as incurred, depending on what it is. I don't really want to get into that because it's tangential and it doesn't really make a huge difference here, but do be aware of that. Some academic sources especially say that you should always capitalize R&D. I don't quite agree with that because it depends on what's in it, and in practice, most companies don't give you enough information for you to be able to make that adjustment. But when you do have the information, and it's more of a business like this where you know about how many years something is going to be good for, then you might make an argument for capitalizing and then amortizing these over time. So we have that. And then let's also get our depreciation and amortization from right here. And then we can add these up. And then operating income is just our net sales minus our operating expenses. Net interest income, we're going to say 0, just so we have that to make it more standard. And so we have the beginnings of our new income statement over here. So we fixed one of the problems with the classification, but we're far from done. The next problem here is that this issue of dividends and the owner draw. So in a lot of small businesses, as is the case here, the owner does not actually pay himself any type of formal salary. Instead, he just does what has been done historically and withdraw money from the business when he needs to use it for something or pay for something. The problem is that it makes metrics like EBITDA too good to be true. Because how many small businesses out there really have 40 or 50% operating margins? That's extremely high in any industry, even something like software or internet. So we would say this needs to be adjusted. And typically what you do here to adjust this is you look at this as an absolute dollar amount, and then you allocate some portion to the different categories: G&A, sales and marketing, and research and development. And that's what we're going to do here. Now, the first thing I'll actually do is go in and I'm going to look at the owner draw as a percentage of gross sales, because that's how we're going to actually project this item going forward. So we'll assume that as the business grows, the owner can simply withdraw more and more cash because margins stay relatively high. So this is a safe assumption to make. I'm going to say 20% for the number here, and then we'll just carry this across. And then for actually linking to this number, let's just take it from our formula here, copy this across. And then let's get it for all the future years as well. So now to allocate this is very subjective, and you'd have to sit down with the owner and figure out how he allocated his time in each year and what he typically spends time doing and what tasks he's responsible for versus employees or contractors at the company. But generally speaking, when a business is new or just starting up, the owner is going to spend a lot of time on administrative tasks, and then relatively less time on sales and marketing and research and development. As it grows, though, he will spend less and less time on the G&A category and more time on the others. So that's what we're going to follow here. So for the allocations, I'm going to say 25%, 20%, 15%, 10%, 10%, 5%, and then 5% going all the way across into the future. For sales and marketing, we'll say 50% of his time was spent on this, and then 50%, 50%, 55%, 55%, and then going forward, 60%, 65%, and then 65% all the way across. And then for R&D, we'll say 25%, 30%, 35%, 35%, 35%, 35%, and then 30% going all the way across. And if you want to, you could add up these numbers as well just to verify that they add up to 100% all the way across, which they do here. Now, these are based on my own rough estimates for how my own time was spent earlier on running and managing this business. But again, you'd have to sit down and make some kind of estimate based on time or employees required to replicate whatever the owner has done or something like that in this case. Now, for the actual allocation in dollar terms, let's take the number up here. We've anchored the row part of that, and then let's multiply by each of these percentages and copy this around and across. And so we have this in place. Now, with all this set up, we actually have enough now to go back in and to flesh out our GAAP version of these financial statements. So for G&A, we're going to take our existing expenses here and just add our owner draw allocation to that. And then for sales and marketing, we'll do the same thing. And then for research and development, we'll do the same thing. So we have that. And with that, we're not completely finished because we still have to copy these across, of course, but we've now modified this and the company itself looks significantly different because of all the changes we've made. And we'll see that later on when we get into the key metrics and ratios on this version of the financial statements as well. But that is how we've set it up here and how we've modified things to create a lower margin business, but also we would argue a more accurate picture of what it really costs to run and build a business like this. So we've allocated the owner draw now. Let's go up and see what is still remaining here and what we still have to do to finish these statements. One other point is that we've intermingled business and personal expenses. The travel and moving expense category we should probably remove, because in a lot of cases, business owners will say that something like a travel expense is for business, but it's really half personal or mostly personal, and they try to deduct things like that to save on taxes. So anything questionable like that. Another example would be hiring family members just so they have spending money and so you can save on taxes. Things like that you should probably remove because they don't contribute anything to the business itself and they're not necessary afterward. Of course, we've already done that because if you noticed, when we went in and calculated all these numbers on the GAAP version of the statements, we did not actually include anything for that category on the travel and moving expenses. So we've already taken care of this step. And so really here, the last step in this part is to figure out the taxes. Now, as you can see from the tax rates over here, these are lower than what you would see for most large corporations based in the US. The rate varies from around 25% to 30% and stays at around 30% over time, because that is closer to what an individual in its tax bracket would probably pay for his personal income taxes. Of course, the corporate tax rate in the US is 35% for large companies. And if an individual with much lower income were buying this, then maybe they'd end up with an actual lower tax rate. Although in most cases, the tax rate tends to go up, not down after an acquisition, because presumably someone larger and with more income is acquiring the company. So we've handled it over here by assuming a 35% tax rate for the potential buyer and looking at everything like that. Now, this isn't going to affect us in the historical period, but it will affect us in the future period because we're not going to end up using the income tax numbers from down here, which we calculated by taking our operating income and multiplying by the tax rate. Instead, we are going to use the potential buyer's tax rate for that. So let's go in and actually flesh out the income statement now, just so we have this. For the income taxes, for the historical period, we're just going to use the income taxes that were reported on the income statement right here. We don't want to rock the boat too much. And then for net income, just pre-tax income minus those income taxes. So for all the historical period, we can really just copy these across. And then going forward, let's just take all of these and copy them across once again. The income taxes are going to be different. So we take our pre-tax income and multiply by the tax rate up there, which is a named cell. And we can copy those across like that. So we have our income statement set up and fleshed out. The next thing to do is to flesh out the rest of the statements. And this is actually the last step of this entire process, recreating the statements. To do this, we're mostly going to link in existing items that have been projected for the balance sheet and the cash flow statement. We will have to adjust two of the items, cash and equity, because we're going to pretend as if that travel and moving expense simply never existed. If that's the case, then the ending cash and equity balances and the numbers each year are going to end up being different. And then, of course, in the future, cash and equity are going to be different because of this, and also because of the tax rate, and also because of the fact that we're now classifying that dividend or owner draw as something on the income statement. And as a result, we're actually saving taxes because we're counting it as a tax deductible expense under the new potential owner of this business. So let's go down and actually start doing this. Accounts receivable, we'll just link to our existing statements over here. And then PP&E and other assets, we have this. And then accounts payable, let's go in and link this as well. So we have this. And then deferred revenue and other current liabilities, we're really doing the same exact thing. Now, some of these we can copy all the way across, and that's all there is to it. Others, we're not going to do that. For the long-term assets, we'll link to our cash flow statement here. For the current liabilities, though, we can just copy these across and the same for deferred revenue over here. So we're keeping all these items the same, even though technically we've changed around our expenses a little bit, because we're assuming that the fact that we've allocated owner draw to these different categories doesn't really affect receivables or payables, because this is just a payout to the owner of the business anyway. So we're assuming that there's a minimal impact, if any, on the balance sheet and cash flow statement items from adding that expense and then removing the travel and moving expense line item. On the cash flow statement, we're largely doing the same thing. I'll link to our net income up here. And then depreciation and amortization, we can just link to our number from right here. And then the change in accounts receivable, we already have all these numbers on our previous cash flow statement. So I can just link those in, add this up and copy these across. And then for the others, really same exact idea. We're just linking to our old numbers directly. And then let's add these up. And then we can copy this across. So we have that. And I'll copy across net income and depreciation amortization. For these other items, technically we could really take any approach, but I'll just do the normal thing and take the old asset number, subtract the new one. And then for the others, for the liabilities, we'll just take the new number and subtract the old one. And the same for deferred revenue right here. So we have this, and then let's copy this across. So for the net change in cash, let's just take our cash flow from operations, cash flow from investing, and cash flow from financing. Copy this across. For the beginning cash balance, we can link to what it was on our previous statements. So we'll link to the beginning cash balance that we had hard-coded on our internal version of the statements here. And then for the ending cash balance, we can just add these up, use a summation formula, or just add them. It doesn't really matter. And then each year, we'll link the beginning cash balance to the ending cash balance from the previous year. So we have that. Up on our balance sheet, let's go down and link to our ending cash balance number right here and copy this across. You can also take this time to just add up all the numbers here and do the same thing for total long-term assets and add up both asset categories as well and copy this across. Now for projecting PP&E and other assets, for PP&E, let's just take our old number and then subtract D&A and also subtract CapEx, making CapEx a positive as always. And then other assets, let's take our old number and then subtract the purchases or sales of other assets. We have that, and we've copied that across. So we have our total assets. Now let's go down and sum up everything on the liability side. We'll copy across these formulas as well. Other non-current liabilities, once again, we need to take the old number and then go down to our cash flow from financing section and actually add the change in other non-current liabilities from right there. Copy this across. And then for total liabilities, total current liabilities plus total long-term liabilities. I should really relabel that. We have that right here, and I've copied that across. Now for total liabilities and equity. Now for equity, you have to be careful because you might think that you can just link to the old numbers and then make it go up or down by the amount of net income or net loss generated each year. We'll try that first, and then I'll point out what the problem with this is and why it doesn't quite work. So let's link to the old equity number first, and then let's just make this go up by the amount of net income generated each year. Remember, we don't have dividends anymore, so the only item from the cash flow statement that flows into equity now is net income at the very top. So let's take this and copy it across. And then total liabilities and equity, let's just add up total liabilities plus equity, and copy this across. And so we can see that our balance sheet is out of balance every single year. The reason for this is the following. When we were modifying the financial statements earlier, we removed this travel and moving expense, but we didn't adjust the taxes. We didn't adjust anything else. We just subtracted out this expense. Now, this expense pushes down the company's net income in the first year, and as a result, its ending equity balance in the first year, at the end of the first year, is also going to be lower by that amount. So to fix this, we need to take our initial equity, and then we need to add back this expense because we are completely removing it from the first year, and this impacted the ending equity balance in that first year. So we'll add this back, and now we can see that our balance sheet balances. And that's how you might actually adjust the statements of a true small business like this. Now, just for comparison purposes, we can also go in and look at our key metrics and ratios here. And unfortunately, I don't have these formulas set up in an easy place to copy and paste from. So you'll just have to bear with me while I go through and set up everything again here. But essentially, we just want these so we can compare and contrast and see how everything is different. Now that we've changed around the presentation of the statements slightly. Now, you might think that everything is going to be relatively the same other than the margins, but remember, we're now looking at these numbers as a percent of net sales, not gross sales. So that alone is going to impact things somewhat. We're focused on this metric now because this is what a company would actually list as revenue on its financial statements. So there will be some minor changes to the other items here. And then for net margin, let's take our net income and divide by our net sales. Let's say NA if it results in an error. And then effective tax rate, same idea. This one will be interesting because this rate's going to be, or appear to be, much higher in those earlier years when we kept the income taxes the same. So we have that. If you're wondering, by the way, about why we kept the income taxes the same, normally on a historical basis, you don't really adjust for this because the buyer of the company doesn't really care what the tax rate has been before. Also, if we move this up, we'd be getting an amount of cash on the balance sheet that's very different potentially. And you normally don't like to do that. For something like changing the tax rate, it really only matters for future periods. So that's why we're taking that approach here. So let's copy all these metrics across now. And we can see just how dramatically this has changed. Our revenue growth is really about the same. Even in the future period, it's around 15 to 20% each year. But our margins are way down. They're closer to 20% now because we're properly factoring in the owner's salary and whatever he pays himself. So it's closer to a real business. 20% margin, 25% margin is much closer to what you'd actually see for something like this. And if you look at publicly traded comparables, you'd probably find margins in a similar range, maybe lower than this though. And the same applies to the EBITDA margin, also a lot lower now. The effective tax rate looks very odd because of the way we reclassify the owner's salary here. But in future periods, it's all pretty standard, around 35%. If you look at the ending cash balance, we end up with only 1.5 million at the end, versus previously, we had only around $1 million at the end. So how is this possible? And if you look at the equity, it's also very strange because we end up with close to $1 million in the old statements versus the new statements, we have, again, more like 1.5 million. Well, the reason why this happens is because we get a lot of tax savings by allocating the owner's salary to these operating expenses instead. Since the potential buyer is presumably a C corporation or a very large private company that pays a certain tax rate that's set, we get a lot of savings by counting the owner now as an employee of this business and actually being able to deduct whatever we pay him. So on the corporate level, the taxes go down. Now, the owner personally really doesn't benefit from this at all because he's still paying the same rate on whatever he earns, but to us as the potential acquirer of the business, we do benefit somewhat from being able to deduct an expense like that. So that's an explanation of how these statements are different and what has changed after the fact. And that really takes us to the end of this lesson. You could go through and do a final check, but I already explained why the cash balances are higher. I explained why the margins are lower, why the growth rates are slightly different. So we've already done all that. To do a quick recap and summary, this is a very high margin business on paper. The problem is that once you subtract out what the owner actually has paid himself, it is a much lower margin business. It's not very capital intensive, and it doesn't require a lot of capex. So in some ways, it's a very appealing business model, but of course, it's also highly dependent on one person. So in that sense, it's not that appealing. For projecting the statements, we looked at the number of new signups and the average customer value. We tied many of the expenses to the employee count and assumed a salary growth in each of those areas. And then we fixed some of the problems with the statements, such as the income statement presentation. We fixed how dividends and owner draw were being treated, the intermingled expenses, and then the tax rate as well. We recreated the statements and then made a few adjustments for cash and equity, but mostly copied and pasted in, or at least linked to the other items. And then we did a final check at the end. So that's about it for this lesson, and I wanted to show you this real-life example of how you actually adjust for and fix these types of accounting and three-statement projection problems. Coming up next, we're going to be looking at the financial statement projections for KakaoTalk, and you will see how a much larger private company is projected somewhat differently, and how the key challenges there are not so much about reclassifying items and making the statements compliant, but more about how you get the numbers in the first place and what assumptions seem reasonable for a future period, especially when the company has not given you specific guidance.